A marble-floored mall, eerily silent. No shoppers, no open stores, just a single washing machine in the atrium, spinning dollar bills behind glass. Across the US, China, and Southeast Asia, malls like this are everywhere. And they're not going out of business. They're expanding. Why? Because these malls aren't meant to sell you anything. They're part of a global financial strategy, one that hides money, avoids taxes, and exploits loopholes. This video uncovers the strange truth behind the profitable illusion of failure. It sounds counterintuitive, but in commercial real estate, an empty mall can sometimes be worth more than a thriving one, at least on paper. Property owners hire appraisers to assign high valuations based not on current rental income, but on potential income, even if the mall has few or no tenants. That inflated value becomes a powerful tool, collateral. Owners use it to secure large loans from banks or private lenders, borrowing against a vision rather than reality. While banks conduct due diligence, many are incentivized to overlook vacancy issues to preserve inflated real estate markets and protect their loan portfolios. The emptiness isn't a flaw, it's a feature. The building's purpose shifts from serving communities to manipulating numbers, where paper value outweighs foot traffic. Once a loan is secured, the process doesn't stop. That same mall, even if mostly empty, becomes leverage for further borrowing. This is where debt stacking kicks in. One property backs a loan for another. That second property secures a third. Soon, a developer or investment group has built a sprawling portfolio of buildings, all financed by interconnected loans that don't require full occupancy to stay afloat. It's a high-wire act of debt, propped up by optimistic appraisals and creative accounting. These collateral chains are fragile yet lucrative, as long as the system holds. With each new deal, the mall transforms from a shopping hub into a placeholder in a high-stakes game of financial musical chairs. Real estate investors wield powerful tax tools to maximize returns. In the United States, depreciation allows owners to deduct a portion of a property's cost annually, as if it were deteriorating, even if its market value is climbing. Under Section 168 of the Internal Revenue Code, certain commercial properties qualify for accelerated depreciation, enabling faster deductions that offset taxable income from other ventures. A barely occupied mall can thus generate significant tax write-offs. Similar tax frameworks exist in countries like Germany, the UK, and Singapore, tailored to local regulations. Another tool is the Real Estate Investment Trust, REIT. By distributing at least 90% of profits to shareholders, REITs avoid corporate income tax. An underperforming mall can be bundled into a REIT alongside stronger assets, stabilizing the portfolio and maintaining investor confidence. These strategies transform empty buildings into tax-efficient vehicles, where tenant counts matter less than financial engineering. Since the early 2010s, Chinese investors have funneled billions into overseas real estate, driven by a need to protect capital from domestic volatility and stringent government controls, limiting annual outflows to $50,000 per person. Properties like malls in Los Angeles, condos in Vancouver, or towers in Kuala Lumpur serve as conduits to bypass these restrictions through layered ownership structures, such as offshore companies or family trusts. A half-empty mall abroad isn't a liability. It's a fortress, requiring minimal upkeep while safeguarding wealth outside China's regulatory reach. While some investors chase speculative profits, for many, the priority is security over revenue. These malls, often held long-term, function as vaults in a global strategy of capital preservation. The US EB-5 program offers foreign nationals a path to green cards by investing at least $900,000 in job-creating projects in targeted employment areas, or $1.8 million elsewhere. Developers tap this capital to fund malls in economically distressed regions where job creation, not retail success, is the primary goal. While EB-5 projects must generate a minimum number of jobs, their viability as shopping centers is often secondary. For investors, the payoff is a visa, not a dividend. Similar visa for investment programs in Canada, Australia, and Portugal have turned real estate into a gateway for residency. Once the immigration goal is achieved, the property's performance may fade in priority. Empty corridors? Perhaps. But for the investor, the mission is complete. Every property has an owner in theory, but tracing the true owner of an underused mall is like navigating a maze of shell companies. Real estate is a favored asset for anonymity, hidden behind layers of limited liability corporations, offshore trusts, and holding entities. In jurisdictions like Delaware, Wyoming, or the British Virgin Islands, beneficial ownership can remain undisclosed, shielding wealth from scrutiny. This opacity is no accident. It's by design. It enables assets to be sheltered from taxation, litigation, or sanctions, and allows capital to move invisibly. The mall ceases to be a public space and becomes a legal smokescreen, obscuring the players behind the transaction. Chongqing, one of China's largest and fastest-growing cities, is a stark example of overbuilt retail. Dozens of shopping centers, some barely completed, stand largely vacant, yet construction presses on. The reason lies in China's economic model. Local governments, reliant on land sales to fund budgets and meet GDP targets, partner with developers and state-backed banks to prioritize building over occupancy. Malls are erected not to meet consumer demand, but to signal economic progress and secure political favor. This creates a self-perpetuating cycle of debt, land deals, and expansion, where square footage trumps tenants. Chongqing's Dead Mall district isn't an outlier. It's a warning of how real estate can serve growth metrics over human needs. An empty mall should raise red flags for lenders, but many prefer not to look too closely. A mall appraised at $100 million when fully leased might be worth half that if 70% vacant. Admitting this would force banks to revalue loans, risking balance sheet losses or loan defaults. Instead, appraisers rely on stabilized projections, assuming the mall will eventually fill up. Regulators often tolerate this, investors buy in, and the system hums along. It's not fraud, it's structured optimism. As long as interest payments arrive, tough questions go unasked. In this ecosystem, denial isn't a flaw. It's a pillar of financial stability. Real estate portfolios gleam on paper, expanding, appreciating, delivering returns. But much of that growth is illusory, driven by reappraisals rather than revenue. A mall, even if 70% empty, can be valued higher this year based on projected income or market comparisons that gloss over reality. These inflated valuations boost net asset values, attract investors, justify bonuses, and unlock new financing. It's a closed loop. Optimistic projections fuel higher values, which draw more capital, spurring further development. Scaled globally, this mirage shapes markets, creating the appearance of wealth as foot traffic dwindles. The mall becomes a symbol of a deeper shift, where value is an agreement, not a fact. This financial sleight of hand doesn't stay in boardrooms. It reshapes communities. Malls built for speculation, not need, consume land, utilities, and public resources that could serve housing or schools. Speculative property values inflate local housing markets, pricing out residents. Infrastructure strains to support empty structures, while public services like transit or education go underfunded. And with tax breaks often granted to developers, municipalities see little revenue in return. Profits are privatized, costs are socialized. Residents face higher rents, hollowed out downtowns, and eroded trust, subsidizing someone else's paper wealth. A mall is an energy-intensive beast, whether bustling or barren. Construction alone, steel, concrete, glass, generates significant embodied carbon. Once built, ghost malls require ongoing security, HVAC, and maintenance to preserve their value. A typical 500,000 square foot mall can consume over 10 million kilowatt of electricity annually, even with minimal occupancy, contributing to emissions and resource waste. Often located on urban fringes, these malls fuel sprawl, encouraging car dependence and undermining efficient city planning. Their environmental toll, from construction to operation, persists indefinitely, a silent cost of buildings that serve capital, not communities. Nearly everything described is legal. These malls meet zoning requirements. Tax strategies are sanctioned by tax codes. Investment structures comply with disclosure rules. But legality doesn't equal public benefit. When wealth is preserved through vacancy, when housing and services lose out to idle assets, when land is consumed to shield capital, who does this system serve? It's built to protect private wealth, not to uplift communities. That's not criminal, but it's questionable. In a world grappling with inequality, housing shortages, and climate change, we must challenge what we permit and why. In many cities, buildings chase capital, not demand. Malls, airports, and towers rise not because they're needed, but because they promise paper returns. Governments fuel this cycle as new projects boost GDP, draw foreign investment, and project prosperity. But the outcome is infrastructure for finance, not function. In Malaysia, megamalls languish with few tenants. In China, business districts stand empty. These aren't missteps. They're byproducts of a system where square footage signals success, even if unused. Concrete becomes a currency, and emptiness a feature of speculative design. Malls are no longer just commercial hubs. In the ghost mall economy, occupancy is beside the point. Ownership, valuation, and the ability to channel money through real estate drive value. These malls are financial instruments, collateral, tax shelters, wealth storage. They thrive not by selling goods, but by fitting into a system that rewards holding over using. Their emptiness is strategic, meeting accounting goals, investment benchmarks, or immigration quotas. A vibrant food court is less valuable than a polished balance sheet. It's not about people. It's about positioning. Illusions have limits, and regulators are starting to respond. The U.S. now mandates beneficial ownership disclosure for real estate transactions. The EU has tightened anti-money laundering rules targeting property investments. China has curbed outbound real estate spending to limit capital flight. Cities like Vancouver and Berlin are experimenting with vacancy taxes or adaptive reuse mandates. These steps aren't revolutionary, but they reflect growing awareness. Using buildings to launder or park wealth has social costs. The rules are shifting, and the illusion is fraying at the edges. Leverage systems thrive on confidence. When banks stop lending against ghost malls, when appraisals face scrutiny, or when investors exit, the collapse can be swift. We saw it in 2008 and in China's recent property slowdown. Debt chains unravel, and one overvalued mall can destabilize entire portfolios. Loans are called, projects stall, and communities are left with half-finished structures and unpaid debts. Ghost malls turn from silent assets to loud liabilities. And when the illusion shatters, it's often the public, not the investor, left to clean up the mess. Not all ghost malls are lost causes. Some have been reborn as schools, community centers, call centers, or even churches. Others host micro-apartments, data centers, or vertical farms, leveraging existing infrastructure, spacious interiors, climate control, sturdy frameworks. But repurposing demands political will, community engagement, and financial alignment. Owners often resist, holding out for future gains. Governments balk at funding conversions. Complex ownership structures, trusts, REITs, offshore entities, complicate negotiations. The potential exists, but systemic barriers persist. In an era of urban challenges, adaptive reuse is a necessity we can't ignore. The ghost mall is more than a real estate quirk. It's a reflection of modern capital flows, rapid, abstract, untethered from human needs. When empty buildings outshine productive businesses, or when land serves as a tax haven rather than a home, we're in a market driven by secrecy, safety, and speculation. These malls aren't failing. They're fulfilling a repurposed role, safeguarding wealth. But at scale, this distorts economies, turning cities into spreadsheets and communities into collateral damage. What kind of growth are we prioritizing, and at what cost? Picture it again. A pristine mall, a lone washing machine spinning dollar bills behind glass. It's absurd, yet it's reality. These malls aren't retail spaces. They're laundromats for capital, cleansing money of visibility, risk, and tax obligations. They churn quietly, generating value for the privileged few. But the toll is paid elsewhere. In hollowed-out cities, unaffordable housing, squandered resources. Absurdity isn't an anomaly in this system. It's the blueprint. Until we redefine the purpose of buildings and who they serve, the machine will keep spinning. The modern economy thrives on appearances, paper value, projected growth, engineered debt. Ghost malls aren't outliers, they're mirrors. Their emptiness isn't failure, it's function. But rewarding idle assets hollows out our cities and systems. The next time you pass a gleaming vacant mall, ask yourself, who wanted it this way and why? What's your take? Should a mall be allowed to succeed without ever opening its doors? Drop your thoughts in the comments. Have you noticed a ghost mall in your city? What do you think it's really for? If this video changed how you view the flow of money, hit subscribe. It supports the channel and lets us keep exploring stories that slip under the radar. And don't miss my last video, on bottled water, marketing myths, and one of the slickest illusions of purity ever sold. Like ghost malls, it's a tale of value. And who gets to define it